This podcast is intended for investment professionals only. All investing involves risk. After 14 years of a Conservative government, Labour now holds the keys to number 10. So far, the reaction of sterling assets has been relatively muted, given the widespread expectation of the general election result. But UK issues are inextricably linked with global events, irrespective of a change of politicians. So how will geopolitics, immigration, deglobalisation and government deficits be addressed? And how, when looking at multi-asset portfolios, might investors wish to consider these tectonic shifts? Our panel of experts, Sonja Laud, Chief Investment Officer, James Carrick, Global Economist, and Chris Jeffery, Head of Macro Strategy, discussed these themes earlier today with Mark Johnson, Head of UK Institutional and Wholesale. Here's what they had to say.
Good afternoon, everybody, and welcome to this UK election. If you were waking up to the results this morning, you would have seen that it was a fairly cataclysmic result for the Conservative Party. The electorate clearly, after 14 years, wanted change, and change is what we've got. Labour achieving the largest majority, I think, since the Blair government, about 174 projected, something like that. The Conservatives achieving their lowest ever share of votes and their lowest ever number of seats. However, some interesting aspects, I think, in the results, that Labour won only about 35% of the votes, which is the lowest ever, I think, for a single party in power. And the turnout, perhaps reflective of that, about 60% of people, I think that's the second lowest ever on record, which maybe says something about the way that people are feeling about their politics right now, their attitudes to Parliament and their attitudes to government. And indeed, in the latest British Social Attitude Survey, 45% said that they don't trust government to put the nation's interests first. That was up from 34% in 2019. So in the next 40 minutes or so, we're going to be considering what all of this means for you, our clients, for investors generally. And I'm delighted to be joined by Sonja Laud, our Chief Investment Officer, by James Carrick, our Global Economist, and Chris Jeffery, our Head of Macro Strategy. And we're going to come to you first, Sonja, for a snap opinion poll, if you like. What are the markets saying about this morning's results?
Thank you, Mark, and a very warm welcome, everyone, and thank you for joining us. I think the very short answer is the response is very muted. So what we are seeing right now is the FTSE 100 flatlining more or less. We have a very, very little reaction in sterling, very slightly up, and likewise for the fixed income side, so gilts have very, very little reaction. Now, we have to put this in context because, of course, prior to the election, we have seen markets pricing in a Labour win. So as such, point one, the polls were very accurate. And that is important because if we think back what we've seen across other elections year to date, that has not always been the case. So no major surprise. And secondly, hence, of course, markets are not operating in isolation just with a focus on the election. So we should not forget that later today, we will get the labour market data in the US, because at the end of the day, as we have said a couple of times, elections will only really matter to markets if there is an expected change to growth, inflation, and the monetary policy reaction function. Of course, elections can always create volatility and noise around the actual event. But if you want to see and want to forecast longer term change, we will need to see the policies that can, in fact, lead to sustainable change in those three factors. And now, of course, if you look at the way the FTSE 100 is reacting, you, of course, can see some sectors that we expect to benefit, like house builders. But rest assured, we will need to see the actual detail on how the new government will implement what they have talked about on the election campaign in order to see, of course, those wins that we're seeing today to be sustainable. Now, what will the market be watching? Maybe initial speeches, what we hear, but it will come down to the budget in late September, early October, because it will all come down to the fiscal policies. Of course, everybody will watch the announcements around tax, although we believe Starmer and Reeves have been very clear on what they can and can't do, or what they're willing to do or not. And as such, we know there is not a lot of wiggle room. There is quite a few savings that they need to find in order to make sure they can support current spending in real terms. The latest stat I've seen is around 15 billion. So there's large numbers they need to address. And as we've learned very painfully in 2022, the market will focus on credibility. Everything they will put forward will be looked at. Is this sustainable? Is this credible? And hence, can we see a path forward that will allow us to judge whether there is an influence on growth, inflation, monetary policy? And I know we will look at these in turn, but just to really set the scene that for the market in the medium to long term, what really matters is those major policy decisions, and those we don't have yet. We have indications, we have areas of focus, but as we know, we will need to see the detail and then the execution in order for having clearer views on specific asset classes. And again, let's not forget, there's other major events, geopolitical and political, that of course will influence the trajectory for the UK. So none of this is happening in isolation and has to be placed in context.
Thanks, Sonja. Let's just turn, James, if we may, to the comments Sonja made about fiscal policy. So during the election campaign, we heard various commitments around tax, but clearly the ambition for any incoming administration is going to be around growth, and you can't have that without necessarily increasing your expenditure. So how is the government going to balance the books and achieve growth?
The Institute of Fiscal Studies reviewed the manifestos, and in net terms, no difference between the Conservatives and Labour. One was giving away taxes and tightening welfare spending. One was spending a bit more, raising a few more taxes. But the net figure, which matters most for the Bank of England, was not much difference. I think we have to give them credibility to stick to spending plans, because that's what the Blair and Brown government of 97-98 did. They didn't really increase government spending until 2000. So if you just look at history, when a centrist change or new Labour comes in, the Blair Brown gives them that credibility. That said, even from the Office of Budget Responsibility, there are concerns about the viability of the previous administration's spending plans, particularly on things like prisons and courts, which have got a lot of backflow. And so, yes, when the government produces a spending review in September ahead of the budget, there is a possibility that they find out that spending is too tough and they do want more resources. And so it wouldn't be a big surprise if they do some tax, which they haven't talked about in the manifesto. If we go back to 97-98, the Blair Brown government did a tax on pensions, reducing the refunds that you got from dividend tax relief. So yes, we could have a tax measure to pay for spending that hasn't been in the manifesto. In terms of how to boost growth, and they've said that growth is the priority on day one, but of course, with that limited fiscal manoeuvre, what we're looking for is reforms of planning. We have a lot of NIMBYism in this country. You can see that from our high-speed rail. Being, nothing done there. We haven't ever met our home building targets. The Labour government has promised to overhaul planning reform. That's a huge obstacle to overcome many departments, so we'll have to wait and see. But if we see encouraging news from that, that could be like the rabbit in the hat for growth that we saw after 97-98 when the Bank of England was made independent. It was something that wasn't heavily talked about, but they did it, and it was a boost to the UK economy.
And just a quick comment, if you may, on the Bank of England, because obviously it was the Brown administration that untethered the Bank of England and made it fully independent. Do you think that's going to change at all with the new administration?
I don't think so. I think the opposite. So we saw with Liz Truss that she announced a budget which didn't have the oversight and the costing from the Office of Budget Responsibility. We're hearing that they're going to mandate that any significant fiscal events will be costed by the Office of Budget Responsibility. So I think they're going to be more pro-credibility than anti-credibility based on what I've seen.
Okay, thanks, James. So, Chris, the big question, rates. So we had the latest inflation numbers, which suggested that the government was achieving its long-term targets. But I know there was a lot of devil in the detail on those numbers and what was included and what wasn't included. But what do you think the agenda is going to look like for rates policy?
Yeah, as you say, there was devil in the detail of those inflation numbers, with particularly the high services figure at 5.7% still kind of causing some concerns. But the Bank of England, if we separate the impact on the rates market as that which operates through the monetary policy channel and that which operates through the fiscal channel, take those in turn. Through the monetary policy channel, the Bank of England, while still voting 7-2 to keep rates on hold, are increasingly talking in a way that is indicative of a cutting cycle that's about to start. And it's in a backdrop in which we've now got 4 out of the 10 G10 central banks cutting rates. So we think the Bank of England will be joining that group in the second half of the year. We think that probably starts as soon as August. We've had this unusual period over the last month with all public sector officials in purdah, where there's been essentially zero communication from the Bank of England to the market. That will resume next week. We expect that to be the direction of travel. So from the monetary policy angle, I think the direction of travel on rates is lower. Then from the fiscal angle, I mean, everybody wants to think about whether comparisons with 2022 are relevant or not. I'd say they are not, emphatically not. So James has already kind of talked a little bit about the manifesto numbers, but I want to put those in context. So the net new spending under the Labour manifesto is costed by the IFS at about £3 billion per annum. Okay, hold that number in your head, 3 billion. If we go back to 2022, the quasi-Kwarteng budget was costed at 160 billion over 5 years. And then there was the infamous interview over the weekend with the promise of more to come. It combined both the biggest package of tax cuts in 50 years and the biggest program of public spending with the energy price guarantees. So it's night and day, really. Yes, this is mildly expansionary fiscal budget relative to what we would have had the election gone the other way, but it's tiny.
But some commentators have suggested that she had a point in her approach, that Liz was trying to bolster productivity in the UK. James has outlined that one of the key ways to unlock that productivity is through planning reform, and I think that's very high on Rachel Reeves' list of things to do. Do you see any other ways that we can achieve a boost in productivity?
But I think the main point is you've got to take the private sector with you. So we know that the UK's chronic problems, I mean, there are many, but from an economics perspective, the UK's chronic problems are a lack of both public sector and private sector investment. We have the lowest share of private sector investment in the as a share of GDP in the G10. I think it's the same on the public side. On the public side, we are getting a new administration that's talking about changing the fiscal rules to now enable more public sector spending. But the real prize is unlocking private sector investment. And that's about both James is talking about on planning, but it's also about providing a backdrop of political stability. So since 2010, I think these numbers are right, we've had 5 prime ministers, 7 chancellors, 9 business secretaries, and 16 housing ministers. That's not stable. You don't need to making a value judgment on the politics to recognise that that's not stable. And hopefully we can have that stability going forwards.
So I saw that early this morning, I think the gilt market opened fairly neutral. Obviously, markets don't like surprises. This was in the market. This was well priced in. What do you think the outlook is for credit? Spreads are at multi-year tights at the moment. Do you see any change to that?
So the credit market has been very integrated globally, with some small differences. We've seen sterling, dollar, and euro credit spreads move down together. For the sterling market in aggregate, my colleagues on the sterling credit team will emphasise ad nauseum that the revenues of the companies in their index are largely international rather than being largely domestic. So you are investing in a sterling credit, but with global exposure, and that's true also of the large cap equity market. So the global fortunes are the number one thing that matters. There are obviously going to be some sector specific issues. We've seen problems in the water sector in particular, with the resolution of that issue having been pushed till after the election. So that becomes on the kind of quite close to the top of the in tray of the new government. But we really think the kind of change in political landscape is a sector by sector story rather than something that matters for credit in aggregate. And there it will, the overall tone of the sterling credit market will be dictated by what goes on a global basis.
And how do you think that factors into our views on asset allocation more generally?
I'd like to come with an interesting story about how we've been changing our UK asset allocation in anticipation of this result, but I don't really have one, because this result was, whilst not a foregone conclusion, as Sonja pointed out, it's pretty much entirely foreseen by the markets. So it's then hard to expect something which is priced with such high certainty to have much of a market impact. our approach remains one of focusing on global diversification rather than a concentration in UK assets. Those UK assets do play a role in all of our portfolios, but it's not one that is particularly outsized. We kind of think it's a proportionate one. Maybe the one area that you could say we can kind of take something from the election result is if we get that focus on planning, that emphasis on political stability, that has the potential to be something which puts upward pressure on the market's estimates of long-term growth in the UK. We primarily see that as a sterling story rather than being a kind of UK asset story if that comes through.
Now, of course, we have to put all of this in the context of we are a very small island and there's an awful lot happening in the world. Some of you may have seen a really excellent article this morning in the FT on geopolitics and the way that actually that is shifting investor sentiment much more than some of the localized politics that we've been discussing. So I kind of want to frame all of this in that context and maybe your views on the sort of the next 6 months of the year. So coming back to you, Sonja, obviously we've got some of the stories coming out of France in terms of how Bardella may fare tomorrow. You've got the second round of elections there. You know, how is he potentially, as the Prime Minister, going to be working alongside Macron for the next couple of years?
You're absolutely right, Mark, that we have to put it in the global context because, as you rightly say, point one, the UK is not operating in isolation, and point two, there is a lot going on the global stage. And it's important to differentiate, but at the same time understand the interconnectedness between geopolitics and politics. And we have, of course, seen some commonality across the elections we have seen already. And what is interesting is you have alluded to some of the interesting stats with regards to participation and the share of votes that Labour was able to win. Because we do know that, particularly in the run-up, we have seen the Reform UK party being very vocal about some of the issues and have called out in their manifesto, which we have to agree are to a large extent what the population will want to see addressed. And these are not just UK specific. We have been seeing this around the world in the elections playing out. And it's interesting that actually, if you look at India, for example, or Mexico or South Africa, that polls didn't quite capture what that kind of backlash would look like. And for all incoming governments, it is very important that they don't ignore this. Those issues, again, are not, just happening overnight. They have been in place for a long period of time. We're talking about inequality. We're talking about the impact that the cost of living crisis had on low-income households, the kind of local impacts of, access to healthcare. We have immigration as a commonality across all of these. And these are themes that will need to be addressed from incoming governments. And the same is true for France. We have seen now a big shift to the right, but likewise, we have seen a big shift to the left. But you see, it's this anger, it's the frustration that incumbent politicians have not been able to acknowledge and put policies forward to address those issues. And we assume that this will continue because these issues are not going away. They're then linked to geopolitics at the same time and will require a very open and honest conversation on how you can address this. And let's face it, this has to be balanced with the need to push growth. So everything we've said until now will not go away. And it's a balancing act to get those policy measures right whilst operating in a fiscally constrained environment. And that is not small feat in achieving this. And as such, we believe that markets will take note on how this will play out and how we can see this move forward. We, of course, will then wait for the US election, where again, we're seeing very heated topics potentially dominating the campaign trail once we have selected the candidates, which I know, of course, for the time being is not a given or not a sure thing. And markets will want to understand how this will potentially influence the global narrative. Because, of course, if we do consider deglobalisation to become a bigger theme, global companies will have to figure out how they will operate in this. We will need to figure out whether this will be inflationary, and hence will, of course, then put upward pressure again on central banks in their consideration of the rates path going forward. So no government, new or old, can ignore global events as they are unfolding and as they're happening. because they will create a far more unstable environment for everyone to operate in. But this is why I've highlighted they need to balance this with the frustration domestically, which again is not specific to any one country, but is quite universal, which has been building over time, but we believe has really been exacerbated by the cost of living crisis and the inflationary shock, because all of a sudden you find that the impact, particularly on lower and medium income households, has really meant that they're facing a decrease in standards of living that they are now telling us they're no longer willing to accept, and they want to see politicians find the right answers. And as such, we have not seen any real shift in the way that the electorate has really given power to one of the extreme rights. And our expectation is the same will happen in France. But we know a hung parliament in France does make for quite uncomfortable reading as well, because it will most likely hold back the necessary reforms to address these issues. And again, the growth aspect and, of course, the issues domestically that need to be resolved. We will look all towards the US, because we know the picture is clearer if it was a clean sweep versus a hung parliament again, because this will determine how we have to look at the path forward. But fiscal, as James very clearly highlighted earlier, will play a big role in the US as well. And the way the market will look at this from a sustainability angle, and hence we will get an insight on how the bond market will react to it, because it's very clear that anything that is not remotely credible and sustainable will be looked at very unfavorable, not potentially quite as painful as we've experienced in 22. But let's face it, right now in the US, we don't have any term premium. So we have to assume that eventually the market will wake up and say, okay, if you continue with your fiscal push, this is growth positive, but surely at one point your fiscal deficit will reach a level where we're quite uncomfortable on financing this. And we should not forget that the interest cost as a percentage of the budget will go up dramatically regardless. And this is, I think it's this fine balance between our expectation for inflation and hence the monetary policy reaction function, because there's a direct impact on the finances of the governments as well.
So, Chris, how do you possibly hedge against some of those unknowns? I mean, you've got a lot of big tectonic shifts that are going to be happening over the next few months. I was looking the other day at the oil price, which is now, I think, back below the level it was at just the day before Russia invaded Ukraine. So we've had these big swings in prices. If you're looking at a multi-asset portfolio, how do you possibly map all of those risks?
That's a very good question. I think you've got to really think about different horizons here. So is it plausible for multi-asset investors or any other kind of investors to be hoping to kind of surf those very short-term fluctuations in political risk? I think the answer is no. But what's your sort of sensible long-term strategy is to understand the kind of tectonic plates that are moving rather than the kind of short-term fluctuations. So as Sonja kind of highlights, the tectonic plate we can identify pretty clearly is that there is a political backlash to the combination of the erosion of living standards and discomfort with high levels of immigration in a large number of countries. We've been talking, Sonja was talking a little bit about France. I just want to bring one fact about France into this conversation I think is useful. In 2017, when Emmanuel Macron became the president, Marine Le Pen became a member of the National Assembly for the first time. National Rally, or it may actually have been the National Front back in those days, got 13% of the vote and won 8 seats. There's a parallel we can draw there that I think people can probably make for themselves that could play out elsewhere. So this has not been a kind of new phenomenon. We've had this phenomenon has been kind of identified as being one of the kind of causal factors behind the Trump victory in 2016. Also played a role clearly in the Brexit vote in 2016. But we have to kind of separate that as a sort of longer term theme from the sort of short term noise. The short term noise, to a certain extent, we are never going to be able to capture kind of those idiosyncratic fluctuations, but we can kind of think about what that long-term consequence means. So one of the things that kind of flows from that is this pressure on fiscal policy. So it's no coincidence, I think, that we've seen this rise in government bond yields, if we think over the last sort of 3 or 4 years, as this pressure for more spending has picked up. Another consequence of this, I think, has been the squeeze on China. So that squeeze on China from Western policymakers is clearly in response to a bunch of things. One of them is a national security concern, but one of them is a concern about competing with China on a global market. So lots of the stuff around kind of electric vehicles, for example, out of Europe in the last month or so is kind of addressing that. And we've seen Chinese assets have really been struggling on an international comparison, whilst that squeeze has been carrying on. The other one I point to would be the bifurcation within lots of large cap equity indices, with the mega caps doing incredibly well and companies that are catering towards sort of mass market consumers struggling somewhat. So that income distribution point that Sonja's making, you can really see it in the performance of different sectors and different corporations. And those are the kind of themes that we can try to get exposure to or try to protect from, rather than the kind of the sort of slings and arrows of the short-term political noise.
So, James, I think I'm right in saying that Rachel Reeves is the first economist to occupy number 11, which must be music to your ears. The Conservatives obviously had a reputation for fiscal prudence, and we don't yet really know what the policies that she's going to unveil will look like. But I just wondered, is there anything in that, having an economist in number 11, somebody who actually understands the dynamics of the market rather than somebody who is perhaps from the more political spectrum?
Yeah, I think you would hope so. Clearly, there was a coordination issue between the Treasury and the Bank of England. If you try to do too much on fiscal, then that can be offset by interest rates, and so that'd be something to take care of. And also the understanding of risk premia. As you said, Liz Truss had a lot of positive supply side reforms, but she didn't allow that to be projected into, well, how much could the economy be in future years? And instead it was all, let's just get the good news out of the way before saying, well, we'll have to have some spending restraint here to make it add up. So maybe it would be more of a considered, logical approach. I was also going to touch on the issues that Sonja and Chris have been raising about the pressure on public finances. I find it disingenuous that we haven't had an adult conversation about demographics. We have made promises to fund healthcare of elderly people and social care, and we've made promises to give our elderly citizens a pension. We have fewer births and rising life expectancy. And so it fascinates me that the politicians say, oh, look, the tax share of a share of GDP is so high. But we have spending commitments. We've promised people that they will be looked after. And I don't think we've had an adult conversation. So I don't know if you need to be an economist for that, but I would welcome an adult conversation at some point and just laying out the truths that we've made these promises. We either fund them or we don't.
It doesn't feel quite like 1997 and Tony Blair and New Labour. There isn't quite the sense of euphoria. I think there is a sense of change and a sense of optimism. And I suppose, Sonja, I'd be interested in your kind of concluding thoughts, perhaps, because we'll be keeping you all apprised as these policies unfold and as the markets react to them over the coming weeks. But how do you feel as of this morning and this afternoon's event, Sonja?
Not very different to yesterday as we started the call, right? Because the expectation clearly was right. And the polls were right, so the surprise factor today is very limited. What we tried during the call, I hope, is demonstrate that the election in and of itself will not lead to change unless we see the policies that will allow us to understand where we are heading. The problems are well articulated and we know them. So in order to get more positive on UK assets, and I will place this in the global context in a minute, we will need to see the relevant reforms and policies being put in place. We know they're not easy. We know they will be constrained in the fiscal headroom they have. And as such, I don't think anyone in the markets particular are not expecting to see any immediate impact. As such, there will be a muted response going forward. The first big event, and I can say we're data dependent as all the central banks are, will be the budget in the autumn, because that will be the first statement of clear intent and the policies we should expect. That has the potential to have a bigger market impact, because that's the first time when we can judge on where we will be heading. The most important takeaway is that this is not an event that will in and of itself change the trajectory. And there's a lot more happening on a global stage that will be more influential than what we will see domestically. And as we've highlighted earlier, this is particularly important because most of the listed securities in the UK will derive most of their revenue from overseas. What we do know is that the geopolitical and political situation creates an environment of uncertainty. And as Chris earlier said, even if we are not really focusing on the near term anyway, because as we believe there will be a lot of near-term noise, be very clear on the scenarios that will actually have a lasting impact on markets. But realistically, whether short-term or even longer term, the level of uncertainty means that hedging is close to impossible. What does it mean? It means that the understanding of diversification will be a very different one in the future world than it was in the past 10, 15 years. Because if we look at the S&P 500's track record over that period, it would have done the trick. You could have made a very good return at actually relatively little risk from having a very simple portfolio allocation. We believe that this will change. And as such, it is the understanding of those risks, making sure that they are placed in scenarios, because we are talking about very distinct events that can change the trajectory. So understanding these, understanding the scenario that could unfold on the back of these, and making sure that you have a good understanding on how this will influence equities, of course, rates and credit and inflation, in order to understand where we will be heading. But it is this diversification piece, because it has been frowned upon simply because risk assets had such an extraordinarily positive backdrop that we want to be very mindful that this is not a given to see this happening going forward, because monetary policy has changed. And even if we are seeing right now that actually fiscal and monetary are working against each other, particularly in the US, there will be a shift going forward, and that will have an implication on markets. Valuation levels are a dreadful indicator for short-term returns. They have a relatively decent predictive power on medium to long-term returns. So these are all the key parameters. That's the goalposts we want to get right as investors. And as such, getting the understanding right of uncorrelated asset classes and return profiles is the way to construct a well-diversified portfolio, and making hence sure that potential tail risk events, and we have said for a while, we believe the probability of these has gone up. But given that the timing is so incredibly uncertain and impossible to predict, it's that diversification aspect that will allow investors to withstand any negative impact on portfolios.
Well, that seems a good place to wrap things up. My thanks to James, to Chris, to Sonja, and to the many of you who have taken time to be with us today. Thank you all. Bye-bye.
As a reminder, this podcast is intended for investment professionals only and shouldn't be shared with a non-professional audience. The views expressed in this podcast are those of Legal and General Investment Management Limited, as at the date of publication. This podcast is for information purposes only, and we are not soliciting any action based on it. The information discusses general economic, market or political issues and/or industry or sector trends. It does not constitute research or investment, legal or tax advice. It is not an offer or recommendation or advertisement to buy or sell securities or pursue a particular investment strategy. Assumptions, opinions, and estimates are provided for illustrative purposes only. There is no guarantee that any forecast made will come to pass. No party shall have any right of action against Legal and General in relation to the accuracy or completeness of the information contained in this podcast. Where this document contains third-party information, the accuracy and completeness of such information cannot be guaranteed, and we accept no responsibility or liability in respect of such information, not for distribution to any person resident in any jurisdiction where such distribution would be contrary to local law or regulation. Copyright 2024. Legal and General Investment Management Limited is authorised and regulated by the Financial Conduct Authority. In Hong Kong, this material is issued by Legal and General Investment Management Asia Limited, regulated by the Hong Kong Securities and Futures Commission. For full terms and conditions, please visit our website. To find more content, you can check us out on X, formerly known as Twitter, LinkedIn, and our website.